Do you remember 2023? It was the modern gold rush. Every day, a new AI startup launched on Product Hunt. Venture capitalists were throwing millions of dollars at anything with .ai in the domain name. It felt like money was free and the possibilities were endless. Founders were pitching decks with zero revenue and getting valuations of $20 million. Fast forward to today, December 2025, the party is officially over. We are currently walking through a digital graveyard. Look at the headlines. Companies that were valued at hundreds of millions of dollars just 18 months ago are being sold for scrap or simply shutting down their servers. The unicorns turned out to be illusions. What happened? Did the technology fail? No, the AI is smarter than ever, but the business models were broken. We are witnessing the great correction, the moment where hype meets unit economics. Today on Info AI Pro, we are dissecting the crash. We will analyze why the wrapper era is dead, how open source models surprisingly killed the SaaS industry, and what it actually takes to survive in the brutal market of 2026. To understand why so many startups are dying right now, we have to understand the mistake investors made 2 years ago. They confused features with products. In 2024, thousands of startups emerged that did one specific thing: an AI that writes marketing emails, an AI that summarizes PDF files, an AI that helps you code Python. These companies raised money believing they were building the next Microsoft or Google, but they had a fatal flaw. They didn't own the intelligence, they were just renting it. They were building castles on rented land, specifically land owned by OpenAI, Google, and Anthropic. When the landlord raised the rent, or worse, decided to build a castle of their own, the startups had nowhere to go. The first and biggest category of failure is what we call the wrapper collapse. A wrapper is a startup that is essentially just a thin user interface placed on top of GPT-4 or Claude. For a while, these businesses looked amazing. They were making $50,000 a month in recurring revenue because regular people didn't know how to use complex APIs. But then, two things happened. First, the models got smarter and cheaper. Second, the model providers started eating their own ecosystem. Remember the startups that focused solely on PDF summarization? OpenAI released an update that let you upload a PDF directly to ChatGPT. Overnight, those startups lost 80% of their user base. Remember the AI copywriting tools? Google integrated Gemini directly into Google Docs. Why pay $20 a month for a separate writing tool when your word processor does it for free? This is called getting Sherlocked. It's a term from the Apple days, but in 2025, it happened at an industrial scale. The lesson here is brutal. If your entire business model is fixing a temporary flaw in a foundational model, you are on borrowed time. There is another factor that nobody talks about which killed the cash flow of these startups: the retention crisis. In the traditional SaaS world, like Salesforce or Dropbox, once a customer signs up, they stay for years. But in the AI world of 2025, user loyalty is non-existent. Data shows that the average AI app loses 90% of its users within the first 30 days. Why? Because AI is often a novelty, not a habit. Users sign up, generate a funny avatar, or write one blog post, get the dopamine hit, and then cancel the subscription. Startups spent millions on marketing to acquire users who only paid for 1 month. This is a mathematical recipe for bankruptcy. You cannot build a billion-dollar company if you have to replace your entire customer base every 3 months. The third reason for the crash is simple math. It's the cost of compute. Software businesses are usually famous for having high margins. Once you write the code, selling it to 1 person or 1 million people costs roughly the same. But AI is different. AI is expensive. Every time a user asks a question, generates an image, or analyzes a dataset, it burns electricity and GPU time. In 2023, startups ignored this. They focused on growth at all costs. They subsidized user queries with VC money, hoping that hardware costs would drop drastically. While chips did get faster, the models got bigger, so the cost remained high. By mid-2025, the VC money dried up. Investors stopped asking, how fast are you growing, and started asking, are you actually profitable? For many, the answer was no. We saw companies spending $1.50 on compute to generate $1 in revenue. That is not a business, that is a charity. And then came the final blow that most investors didn't predict, the rise of open source. While startups were busy paying OpenAI for API access, Meta and other open source labs released powerful models like LLaMA 4 that could run locally or cheaply on private servers. Suddenly, enterprise clients ask themselves, why should we pay this startup a premium to route our data to OpenAI when we can run a LLaMA model on our own secure servers for a fraction of the cost? The value proposition of the middleman evaporated. Open source democratized the intelligence so much that intelligence itself became a commodity. You can't charge a premium for water when it's raining outside. This forced prices down to zero, destroying the margins of paid startups. All of this led to the aggressive consolidation by big tech. There was a narrative that AI would democratize power, that a team of 3 people in a garage could beat Google. That turned out to be a fantasy. Building state-of-the-art AI requires 3 things: massive amounts of data, billions of dollars in hardware, and distribution. Google, Microsoft, Apple, and Meta all have 3. Startups have none. In 2025, we saw the acqui-hire trend explode. Big tech companies didn't buy the startups for their products, they bought them for their talent. They hired the engineers and shut down the apps. The market has centralized. The operating system won. Apple Intelligence integrated AI so deeply into the iPhone that third-party AI apps became redundant for the average user. It turns out people don't want 50 different AI apps. They want one AI that knows everything about them. So, is it all doom and gloom? No, there are survivors, and they look very different from the failures. The companies that are thriving in late 2025 are the vertical AI companies. They didn't try to build ChatGPT for everyone. They built AI for dentists, AI for maritime law, or AI for bioresearch. These companies survived because they had a moat. They had proprietary data that OpenAI didn't have. They had deep integration into specific industry workflows. They weren't just selling text generation, they were selling a solution to a specific, painful, expensive problem. The crash of 2025 cleared out the noise. The speculators are gone. The tourists are gone. What remains are the serious businesses building real value on top of this technology. We are entering a healthier, more mature phase of the AI revolution. The Wild West days are behind us. If you're looking to build or invest in AI now, ask yourself, does this company have a defensible advantage, or is it just another wrapper waiting to be Sherlocked? The technology is here to stay, but the free ride is over. Before we wrap up, a very important note. This video is for educational and informational purposes only. The analysis provided here regarding market trends, startups, and economic shifts does not constitute financial or investment advice. The tech market is highly volatile. Always do your own research or consult with a certified financial advisor before making any investment decisions. Thank you for watching Info AI Pro. If you enjoyed this market analysis, hit that like button and subscribe for more deep dives into the reality of artificial intelligence. I'll see you in the next one.